Why do the rich pay less taxes, possibly, than you do? Today, we're going to talk about that specifically. There's two things that are guaranteed in life: death and taxes. So we have to plan and we have to prepare for them. I believe one of the biggest repressors, things that actually pulls you back or keeps you from growing significant wealth, is taxes. I'm not opposed to paying taxes, but what I am opposed to is paying more taxes than we should. And for some reason, there's a culture today that believes that people that are actually saving money in taxes through strategy are doing something illegal. That's not the case. That's the reason, by the way, the IRS has a tax code. We'll call it the Bible for how we can save money in taxes. Now, the challenge is there's thousands of pages of tax code. Some of the strategies that I'm going to discuss are not always appropriate for everybody. This is not to be considered investment advice or even tax advice. I know that sounds crazy because there's a lot of people out there that are actually giving advice. So think about getting the right advice for your personal situation before you take action on any of these or any other ideas that you hear out there. At base, we have several different types of taxes that you're going to pay along the way. One is ordinary income tax, oftentimes your highest taxed bracket. Right now, as I'm shooting this in 2025, the federal level is 37%. That means that if you make a certain amount of money, you could pay up to 37% federally on your taxes. And then depending on where you live, you could also have state taxes and local taxes, which could, in some areas like New York and California and others, raise your total tax number to over 50%, some areas over 60%. So let's talk specifically about some of the things that wealthy families, wealthy investors are doing to reduce their taxes. So the first thing they're doing for sure is they're paying attention to all of the opportunities in the code. Some things like utilizing the Augusta rule, renting maybe their home to themselves out. So that way they're taking income from their business, but they're paying it to themselves in a tax-free manner up to 14 times a year. That's a big deal. You can make a lot of money that way, save a lot of money in taxes. It's definitely something you should be thinking about. Another thing that they're doing is they're buying their vehicles through their company. Why? Because now what happens is you get the ability to deduct it, especially if you lease it for sure. If you buy a larger SUV, you can deduct it based on the size and weight. You get the ability to deduct that in the year. It's very important. The other thing that a lot of wealthy families will do is they'll take advantage as they own real estate and taking loans from the bank from real estate they own, which is income that's tax-free, and then they'll take that money from an asset and they'll invest it to buy another asset. Let's dive into that just for a minute. When you invest in real estate, there's a depreciation rule. Right now it's at 60%. If some of the Trump tax laws take effect, again, it could go to 100%, which means you're allowed to depreciate a significant amount of that value that you paid for the property. Now, let's break this down for a minute. Let's say you buy a property. You put down $100,000 or $200,000, but then you borrow $400,000. And then you buy, obviously in that scenario, a $600,000 property that you're going to use as an income-generating property. You're going to have the ability to depreciate a certain portion of that property that year on your taxes. Now, if you put cost segregation on top of that, now what happens is you're literally putting rocket fuel on the amount that you can deduct that year. What do I mean by that? Well, in that property that you purchased, there's a lot of different things that the government will give you in the IRS code as an opportunity to deduct over time. Most CPAs or most accountants will be able to depreciate maybe improvements or other little things along the way, and those are beneficial. But if you actually spend a little more money to do what's called a cost segregation study, typically it's going to cost you, depending on the project, thousands of dollars or more. But here's the benefit. If you have $1 million property and you do a cost segregation study, there was a real world case that we literally just did a project for a client and it helped them save over $150,000 in real taxes this year. You can do a cost segregation study, which basically in a simplest form is maximizing all of the different intricacies of that building, the wiring, the nuts, the bolts, the nails, everything, and kind of pricing out what these things could be. And instead of taking 20 or 30 years to depreciate the value, you do it in a more ramped up version, a year, 2 years max, which causes you to pay less money in taxes. You're upfronting some of the tax savings that you're getting on the project and on the property. You're now in a place where you have additional cash flow because you're not paying as much in general taxes because it flows over to your total tax bill, and you can take some additional income and invest back into your property, which is improvements, which you get to deduct on as well. And now as you're investing back into your property, guess what it does? It increases your appreciation value or the value of your property that it's going to grow to because it looks nicer, it looks better, you're improving it, you're refurbing it, so to speak, than if you just did the traditional CPA method. So I want to challenge you to think about not only advanced depreciation, but also cost segregation studies. Earmark that in your brain. Do some research around that if you have investment properties, commercial or residential investment properties. What can I do to apply these studies to this project and fast forward or front load the tax savings in a year or two instead of taking 10, 15, 20 years to depreciate over time. It's a big strategy a lot of wealthy families will use to save significant monies in taxes on real estate that they own now. The other thing that I would challenge you to think about along the way, which wealthy families are doing, is making sure that when they receive income, it doesn't necessarily flow to them personally always. Oftentimes it goes to a business or another entity. And they're doing it in such a way so they can really evaluate how much income should they take or not take personally, and then leave income in other entities so that way they can make their ordinary income reduced. Remember, it's the old idea of controlling things, whether it be through trusts or other entities, but not actually owning things. The wealthy are taking advantage of some of these things, and they're also, by the way, investing in structures, investments, that oftentimes will give them the ability to receive dividends and distributions in a capital gains tax structure instead of ordinary income. Do you know that if you buy a stock and you sell a stock within a year, you're going to pay ordinary income tax on that sale? So let's say you love Tesla, or you love Apple, or you love Nvidia, or you love Amazon, or whatever, and you buy that stock and then you sell it within 1 year. Before a year, you're in a place where you're going to pay ordinary income taxes on that. Whereas if you hold that stock over a year, you're going to pay long-term or capital gains taxes on that. It's very important. That's a difference of anywhere between 10 to 15 or 20 almost percent roughly of taxes difference on what you would pay on the same stock. So pay attention to what you're doing as far as your investments, so that way you can be capital gains taxes instead of ordinary income taxes. So let's talk about donations. That's one thing that wealthy families will do to reduce their taxes significantly. Now, many of you, if you're not wealthy as you're listening to this, maybe you're in a place where you look at the Red Cross or you look at your church and you write a check and you give them money. It's a donation. It's great. And it's a dollar for dollar donation. So when you give them $100, you get a $100 tax deduction on your income. What a lot of wealthy families will do is they will either, number one, set up foundations or endowments or just trusts that they have in general. But if you want to take it one step further to maximize that donation, you can actually participate in using Section 170 of the IRS code, which is when you actually take a look at using the highest and best use value. So there's these structures out there that are actually investment structures, which used correctly or when used correctly, can give you the ability to actually have significant tax deduction, a 3 to 4 to 5 times tax deduction. So let me play that out for you. Instead of them giving $1 and getting a $1 tax deduction on their donation, they could give $1 and get a $5 deduction on that donation. Now, why is that important? Because if you do the math and you say, okay, if I gave $100,000, I'm going to get a $500,000 ordinary income deduction on what I gave. Now, this is all using the code, and it's through special types of structures that are designed for this specifically, and this is for accredited investors only, which means you have to make a certain amount of income, a couple $100,000 a year, or have at least 1.2 million in assets or more. That's why you want to grow your income to get to the places so you can use some of these things. But here's the benefit of it. They give that $100,000, they get a $500,000 ordinary income deduction, and now with that deduction, they have the opportunity to reduce their taxes by that amount. Now imagine they're in an effective tax bracket of, let's say, 40%, because they have federal and they have some state. A 40% tax bracket on $500,000 is $200,000 of actual taxes. So imagine you put $100,000 in to save $200,000. Well, before, if you wrote a check for $100,000 to the charity, it's going to come out of your money. So $100,000 is going to go to them. Whereas by doing this strategy, you put $100,000 into the strategy, your real tax savings is roughly $200,000. And now that savings of $100,000, you can give to your church or charity or whatever, and you're basically doing it for free. Because if you didn't do the strategy, you'd be giving your own money. Now by doing the strategy, you're in a place where you're saving additional monies in taxes, and that monies that you save, you now gave. So it's either you want to give it to the IRS or do you want to give it to the charity of your choice. There's so many different types of things out there, but this is one that you can utilize to maximize how you're donating and how you're giving. Very important. Now, if you're not wealthy and you're building and you're growing, you want to repress and keep those taxes down. Maybe you're in a place where you're saying, Mike, I think I'm paying too much money in taxes. What can I do? Well, one of the things that you want to do is you want to take the income that you have, take that monies and use it to your benefit. Am I spending the current money that I'm earning on liabilities or assets? An asset is something that grows in value, like real estate, stocks, other types of investments over time grow in value. Hopefully that's the goal. As you grow wealth, borrow money and buy an asset that appreciates in value. Now I got to tell you, remember your highest taxed asset is your income, ordinary income, if you're getting paid as a W-2 employee. So if you're doing that, one great thought here for those of you that are W-2 out there, maybe you're making a higher income or maybe you aspire to that. A great thought when you work for a company is to ask them, them, is there a way that I can actually take my income that you're paying me via W-2 and turn it into you paying me 1099? In other words, you set up an LLC, Johnny's LLC, and now your business, the company that you're working for, pays that LLC instead of paying you as a W-2 employee. Why is that important? Well, because it gives you the ability to now, as another facet, reduce your taxes. If you're paid as a W-2 income, your taxes are withheld, you're paid on your ordinary income, and your tax bracket's pretty much your tax bracket. But when you're paid as a 1099 employee, you're paid as though you own an LLC, which you do. It's not that complicated to set up. Now you're in a place where you get deductions. You get the ability to deduct a lot of different things throughout your life, like your gas, like your vehicle. You're gonna have the ability to deduct certain foods, certain clothing, parts of your house, your electric, all kinds of other things you're going to get to deduct along the way because it's being paid as a 1099 to you as a business. And as you deduct those things, how you operate, how you live, some of your expenditures, it's going to ultimately reduce the amount of monies that you're going to pay on your taxes. If you have that conversation with your employer, here's the benefit that they get. They're not now paying employment tax on your income. They're also not paying, the Medicare and all of that goes on top. That's kind of baked on top. If you're making $20 an hour, they're paying more than $20 an hour for you to actually work there. So they're saving money on you, and you then get the ability to save money on your taxes along the way. It's literally a huge win-win. And I think there's a lot of people that can confine or define their job roles as a, quote, consultant or outside type of personality where they can be paid to an LLC, save money in taxes along the way, and write a lot of things off. What if you could be in a place where the income that you are receiving, and then whatever you spend for your day-to-day needs, and then the rest of it you decided to invest into something new that maybe as you were investing into it, it was all a write-off because you're starting a new business, or you're investing in real estate, or you're doing something else. In other words, strategically starting to think like an entrepreneur. I know that that's not easy and not natural for many people to do, but remember, the way that you get down the path of adding strategy like billionaires, most of them didn't start as billionaires, right? But they started learning this, and then they learned that, and then they applied these principles along the way. Now, you might say, Mike, I don't know if the employer that I'm working for would be willing to do that. Well, first off, not every position, not every job, the employer is going to have the ability to do that. Maybe you're working for a company as a W-2 employee. You have a 401k. Are you matching that 401k? Are you reinvesting some of the income that you're earning to put as much to max out your 401k? Why? Because that 401k is going to not only reduce your income taxes for the year as you invest into something that grows tax deferred, but then down the road, there's ways that you can take that monies and then convert it to a Roth so that it ultimately grows tax-free. Something you need to be thinking about. These all sound great maybe to you, and you've heard lots of people talk about them along the way, but the idea that you must get your habits under control. That's what a lot of people are not talking about. They're talking about taking your money and go invest here and go invest there. They're not talking to you about the idea of stop spending money on liabilities, things that depreciate because you want the new bag. If you're ladies out there, you want a bag that everybody says, wow, that's beautiful, it's amazing. Or you want the new car that you're leasing or buying just so you can look cool. Or you want the new watch. Or you go to these restaurants. Or you want to buy everybody a round of drinks every time you're out so it makes you feel good. I don't know where you are, but that often happens with younger investors. And if you have challenges with that, think to yourself, who are you as a person? If those are the kinds of things that you need to do to validate who you are as a person, when you actually start to build and grow some wealth, you potentially may not be able to sustain it because you haven't fixed the core. Maybe what you start with is the idea of what am I currently doing with my spending? Dave Ramsey talks a lot about spending. I agree with Dave in some capacities. I disagree with him in other capacities. But the idea of living beneath your means is absolutely necessary and important if you want to have the ability to create traction, to grow your wealth, and then to participate in some opportunities where you can reduce taxes as your wealth grows, increase cash flow as your wealth grows. Listen, as always, thanks for tuning in, dialing in. If you have any thoughts or ideas, we would love to hear them in the comments. Send us a message. We want that feedback. We've been doing this a long time for families throughout the country. We really want to get some ideas and value to you that I think is going to be making big impacts on your life. Like and subscribe so you can get more of this content. And be on the lookout for some other great content that we're going to put out to help you educate and empower yourself in simple ways so you can make better decisions and build your own wealth and save in taxes along the way. Be blessed. Talk to you soon.